What's up guys, if you're wondering what investment bankers do, you're not alone. It's such a broad term and very few people know what it actually involves. So I'm going to break it down and give you a flavor of what I do as an associate director within leverage finance, how deals work, and what a typical day looks like. Now leverage finance is only one part of investment banking, but a lot of the job is the same as other front office roles, just applied in a different context. So you'll no doubt find it useful. And if you're new here, I'm Harris, an investment banker and CFA charter holder who studied at Imperial College London. So let's start with what leverage finance actually is. Now everyone's heard of M&A or mergers and acquisitions, where private equity firms or companies buy other companies, but how are these acquisitions funded? Well, sometimes the buyer will use just cash, i.e. equity, to buy the company. However, typically equity is more expensive than debt, so if they can, they will use a combination of debt and equity to buy the company and improve their returns. To put some numbers to this, let's look at an example. So let's say a private equity firm wants to buy a company that's worth $1 billion. There's two ways that they could fund this. So scenario one is they fund it all cash, i.e. equity, so they put $1 billion of their own money down. The second scenario is they fund it through a combination of cash, i.e. equity, and debt. So let's say 50-50. They put 500 million of cash/equity and they raise 500 million of debt to finance the £1 billion transaction. And the introduction of debt means this transaction is now considered a leverage transaction. Now let's say after 3 years, the company is now worth $1.5 billion and the private equity firm sells. So in scenario one, the transaction was funded all cash/equity. So the private equity firm keeps all $1.5 billion, which is a 500 million profit on their initial $1 billion investment, or a 50% return. In scenario 2, 50% of the transaction was initially funded by debt, so when they sell for $1.5 billion, they still have to return the 500 million that they borrowed, and then they keep the remaining 1 billion, which versus their 500 million initial investment is a 100% return. So as you can see, the purchase price was the same at $1 billion, and the sale price was the same at $1.5 billion, and the profit in dollar terms was still 500 million. However, the initial down payment was lower in the second scenario, which meant that the return was 100% rather than 50%. Now, of course, this is a simplified example because the private equity firm would have to pay interest and fees on the debt that they raised. However, excluding that for now for simplicity, this demonstrates the power of leverage. So the question is, where do they get this debt? Well, there's a few options, and the first is via banks. However, it's very difficult to raise anything more than around $200 million from banks because banks have a maximum hold appetite of around $25 million, so you need a lot of banks if you want to raise anything more than $200 million. The second option is the capital markets, and this is where you raise the debt from institutional investors such as asset managers, pension funds, and CLOs, which are collateralized loan obligations. Now, all of these institutional investors are funds which pool capital from multiple investors and then invest this in debt instruments such as bonds or leverage loans, and these instruments are what private equity firms use to finance the acquisitions. However, the private equity firm can't raise directly from the institutional investors, so you need someone to facilitate this raise, and this is where investment banks come in. So investment banks essentially work as facilitators or arrangers, and they'll work with the private equity firm and the company that's being bought, and they will go out to the capital markets and arrange for all of that capital to be raised. And in the process, they'll make fees and so on and so forth. Now, there's a lot more detail to this, and I can cover that in another video, but one point to call out is raising money in the capital markets is typically considered more of a public issuance, and that brings certain disclosure requirements with it. Now, the third major alternative in terms of raising this capital is the private credit market, and this involves private debt funds or credit funds raising capital from investors and specifically investing in things like leverage loans or bonds. And this capital will be raised from private credit funds or debt funds, which essentially pool funds from investors and then invest directly in these sorts of acquisitions. There is no requirement for an investment bank to facilitate this, and this is why they're also known as direct lenders. Since they operate in the private markets, there's far less information and disclosure requirement, and therefore these funds are typically more nimble and less subject to regulation, so they can put out larger quantums at different terms, although they tend to be more expensive. So to summarize, the three main sources of capital are banks, capital markets, and the private credit market. Now, this entire engine and process of financing acquisitions through debt is called leverage finance. Now, funding acquisitions through debt sounds great, but it's also very risky, and the reason for that is that debt carries interest and that must be contractually paid. So if a business that has a lot of debt, i.e. it's highly levered, is struggling, it must still pay this interest, which can further cause strain in a downside scenario. And ultimately, if it can't generate enough cash to pay this interest, it will be considered to have defaulted on its debt, and thus the debt providers will step in and take the keys to the company. The process of stepping in and trying to recuperate your money is very complicated and something that everybody wants to avoid. So as a result, highly levered transactions carry with them a lot of risk. Because of this risk, debt providers charge higher interest and fees to compensate them for this risk. Now, given there's often millions, if not billions, on the line, the analysis that goes into structuring these deals is very important, and this is what we do day to day. Now, real quick, one of the main ways that I upskilled in finance was through doing the CFA Charter, which is one of the top finance qualifications in the world. But more than 50% of people fail their CFA exams because they don't have the right strategy, they're not efficient learners, and they don't have anyone to turn to for help. And in the process, they waste hundreds of hours and thousands of dollars on resets. So if you want to avoid this and you want to pass your CFA exams first time, I have something perfect for you. Check out the first link in the description. So let's briefly touch on the types of deals that we work on. And the first one is leverage buyout, which is everything that we've just discussed, where private equity firms raise debt to finance the acquisitions. We also work on refinancing, so once the acquisition is complete, the debt will be in place, but it will have a maturity, and as that debt approaches maturity, it has to be refinanced, and so we step in and arrange a new financing package. We also work on repricing, so this typically involves pricing the debt down, i.e. making it cheaper. So if market conditions improve, a sponsor, i.e. the private equity firm that owns the company, may decide to go back to the market and see if they can raise that debt at a cheaper price. And finally, we work on recapitalizations, which involves changing the mix of debt and equity in the business. Sometimes that's to enable a dividend where the sponsor or the private equity firm will take some cash out of the business and replace it with debt. So what do we do day to day in leverage finance? The first thing is deal origination, i.e. finding new deals to work on. So we have relationships with sponsors, i.e. private equity firms, companies themselves, advisors who facilitate transactions, and also generally other banks. And ultimately, we're in constant dialogue to assess what opportunities might be coming to market. Otherwise, we're constantly monitoring the market to assess what acquisition, refinancing, or repricing opportunities may be coming up. Now, once an opportunity lands on our desk, we will then conduct due diligence. So this involves reviewing the confidential information memorandum, or the SIM, alongside public filings and any other information available to assess the business and the industry that it plays in. We'll analyze the business model, industry trends, competitors, and key risks. We'll also work with diligence providers, i.e. consultants such as Bain or BCG, alongside the management team to assess specific things that we need to understand. Then we'll spend time building financial models, which is a key part of structuring the deal and understanding what debt package is most suitable. So we'll build cash flow models to see how much debt the company can support, and we'll run various scenarios and stress test the business to see how it fares in different circumstances. We'll also look at different debt structures, so it might be a combination of bonds and loans, it might be unitranche, it might be senior or mezzanine debt. And ultimately, all of these have different characteristics, different pricing, tenors, and so on. So we want to assess which one suits this business best. If you want to get good at financial modeling, you should check out my video on how to build a dynamic model in less than 15 minutes. And beyond this, if you want to become an expert, you should consider Wall Street Oasis's market-leading courses that are used by top-tier banks. And I've secured you 20% off. The coupon and links are in the description. Okay, once we've done the due diligence and built the financial model, we then need to construct a credit memo and take this to the investment committee to receive approval. So in the memo, we'll cover the full business profile, the transaction summary, the deal structure alongside risk and returns. And then once we've obtained investment committee approval, it's on to negotiating and finalizing legal documentation. Now here we work with lawyers, the sponsor, the company, and other investors to finalize the terms of the loan. Now this part of the deal can become super technical, and it's more like being a lawyer than a banker, but ultimately as an associate director, and particularly as a director, you need to have a very solid understanding of this phase of the deal. Now the loan agreement will detail a lot of things, and it includes things like commercial terms, so what the loan is, how it's going to be used, the length of it, pricing, and then beyond this, a lot of controls around what the borrower and the lender can and can't do. And this needs to be watertight because, as I said, these deals can be very high risk, and there is a possibility, a strong possibility sometimes, that things could go wrong. So the doc governs what will happen if things do go wrong. Once this is done, it's all signed, sealed, delivered, then the funding will take place. And then as an origination team, we hand this over to our portfolio team that monitors the company and the relationship on an ongoing basis. Cool, so that's what we do. What does it take to succeed? Well, leverage finance is a high stakes and high pressure environment. As I said, there's a lot riding on these deals, and they often move super quickly, so you're working to tight deadlines under high pressure. Beyond this, you also have to balance competitive dynamics, because as a bank, you want to be on the deal, but you also have constraints around your risk appetite. So ultimately, you're trying to balance how far you can push that appetite to ensure you secure the deal without blowing up your entire balance sheet. Also, within leverage finance, you're very exposed to market volatility, so things like changing interest rates, widening credit spreads, or changes in investor appetite. And this is all especially important if you're underwriting the deal, i.e. if the bank agrees to provide the entire quantum to the sponsor and the company and then takes the risk for actually placing that in the market. Any shifts in the market will expose you and you may be left holding a much larger amount than you want to, and then ultimately you have to sell that at a loss. Now, the mechanics of underwriting can be technical and lengthy, so I'm not going to cover it now, but if you're interested, drop a comment below. You're also constantly balancing conflicting needs. Now, as I said to you, this is a super competitive space, and sponsors, i.e. private equity firms, are also very aggressive and pushing certain terms, whereas banks want certain protections, so it's a constant balancing act of the two. Ultimately, we want to do deals and make money, but you don't want to take too much risk and risk losing that money. Now, in terms of skills you need to succeed, I would split it into technical and soft skills. So you need to have a thorough understanding of finance, of capital markets, and different debt instruments. You also need to know how to conduct credit analysis, build financial models, and also structure the deal itself. So I think that's one of the best parts of this job because it's very wide ranging and it also requires a very pure understanding of finance, so it's actually a lot of fun. On the soft skills side, there's a few important things. Firstly, time management is very important. As I alluded to earlier, it's a very high pressure, high stakes game with tight timelines and you're often balancing multiple deals, so you need to effectively manage your time. You also have to be an excellent communicator, both verbally and written. So you're having a lot of conversations with a lot of stakeholders, and it's a quasi-sales role because you have to sell the deal internally to investment committee, but also externally to investors. And then you're writing a lot of memos as well, so you need to be a crisp, concise writer. Negotiation and persuasion becomes increasingly important as you become an associate director and director, because ultimately this is a game of negotiation with sponsors, lawyers, etc. And finally, relationship building is very important because, as I said, there's a lot of stakeholders and you need to be at the table every single time if you want to get deals done. So there you have it, a summary of what I do within leverage finance. Ultimately, we are structuring and executing high stakes and highly complex deals. It's fast-paced, analytical, and negotiation heavy. However, if you enjoy working on big deals and essentially playing this big game of chess, it's an excellent career. So if you found this interesting and you'd like to see anything else, drop a comment below. And otherwise, if you like this, you're going to love these two on screen. Thanks for your time and see you in the next video.